The Federal Reserve is cutting interest rates today amid fears about the coronavirus outbreak. The Dow, S&P 500, and the Nasdaq all fell into correction territory last week.
But the market surged yesterday following the Federal Reserve's statement on Friday pledging support for the markets. Axios chief financial correspondent Felix Salmon is joining us now to talk more about just how the markets are responding to the outbreak. Well, how are they responding? They've been sort of up and down and all over the place. But let's start with what's happening with the U.S. markets, what happened last week, right? They fell into correction territory. That's what people say to me. I don't know what that means. What does that mean?
Okay, technically all that this correction means is that stocks are 10% or more lower than they were at the very, very peak of the market. Now, it happens that the peak of the market was post-coronavirus, was actually in about mid-February. We started hitting new highs, and then they fell back from those new highs. So now they're like a little bit more than 10% below those highs. That means that stocks are in a correction. Now, as we know, if you've been paying any attention at all to the stock market, stocks are incredibly volatile. They can go up or down 3 or 4% in a single day. They did that yesterday. And so it's really hard to get a very strong impression of what the markets are telling us from day to day when they can move around so much, or at least when the stock market can move around so much. The more interesting and the more sober market, the market we should really probably be looking at instead of the stock market, is the bond market. And the bond market is saying, we have problems here. The 10-year bond is at absolute record lows. The yield you can get by holding government debt is lower than it was even at the height of the financial crisis, when everyone wanted the safety of that U.S. government debt. And that's a real vote of no confidence in the American and the global economy.
So there are limits, though, Felix, as you know. I mean, so the Fed's cut rate today. Market has been responding to that, but there really are limits to what a rate cut can do, especially when rates are already so low. Certainly, they can bolster confidence in the markets, at least in the short term. But a rate cut is not going to keep workers from going to work. It's not going to rebuild supply chains. It's not going to allow the economies in Asia and some other European countries to recover as rapidly as people would like them to. And I mean the economy. I don't mean the market. So now that
absolutely, you're 100% right. And you know, as people are saying on Twitter right now, if you go to your doctor and say, I've got coronavirus, and he says, here, have a 50 basis point rate cut, you're like, great, thanks.
Right.
It doesn't help anything real in the economy. If people aren't traveling, if people aren't shopping, if people aren't committing that kind of economic activity, especially in China, but even in the United States, then that's going to cause a massive economic slowdown. The way that Fed rate cuts normally help the economy is by saying, well, what will happen is the Fed will lend money to the banks will lend money to businesses, the businesses will hire people, spend more money. That kind of stuff is not the problem. The problem is not that businesses aren't spending enough money. The problem is that people aren't spending, people aren't traveling, people aren't going out. And that kind of problem is not really something that the Fed can do anything about.
So then what if I say this, Felix? I mean, this is not the first time we've seen something like this. You know, there was SARS 1 and 2, I don't know, the avian flu. I mean, you name it. We've sort of seen these sort of illnesses, I don't want to call them a pandemic because nobody is, before, and the markets bounce back.
Correct. And they could easily bounce back this time. And again, we have to just treat the markets as a symptom, as telling us, like, how healthy is the global economy looking, rather than like as the main thing that we're trying to address. Whether the markets go up and down ultimately doesn't matter that much. Whether the economy grows or shrinks matters much more, and that is a function of how coronavirus spreads. The thing about SARS and MERS and avian flu and Ebola and all of those is they didn't cause any significant slowdown in the American economy. They didn't cause any significant change of behavior by the American consumer. We're already seeing a very different story playing out in coronavirus. We're seeing empty shelves in supermarkets. We're seeing the kind of things that we used to see only in places like Hong Kong, now happening in places like San Francisco. And that means that coronavirus has already hit the American economy much more than any of the previous epidemics that you talked about.
So, Felix, two things, I guess. As you recall, going into the 2007-2009 recession, the Fed cut rates from above 5%. right? If this doesn't work, if the markets continue to weaken, if the economies continue to weaken around the world, how much room is left? We've already slashed rates. I don't believe that there's a lot of room left for the Fed to maneuver if we continue to see weakness.
Correct. The Fed doesn't have much room to cut rates. European and Asian central banks don't have a lot of room to cut rates. The U.S. government, the other side of the coin being fiscal policy, how much the government spends, the government already has $1 trillion deficit, so it's not clear that the government has much room to spend more, to borrow more. So you're absolutely right that the fiscal stimulus and the monetary stimulus, the economic policymakers can do is decidedly limited. The real activity that we really need to be concentrating on, honestly, is epidemiological and medical, and trying to make sure that the virus does not spread in the real world.
Really important information there. Felix Salmon, always great to have you, my friend. Thank you.
Thank you.